Masayoshi Son, the founder and CEO of Softbank, is often in the press for his investment decision-making. The investor has been well known since the late 90s, when his investments in companies such as Yahoo in 1995 and Alibaba in 1999 put him on the map. Buying into the Alibaba idea in 1999, Son invested $20 million into the firm, and the 29% stake is now worth in excess of $120 billion. The Korean-Japanese billionaire is perhaps best known for his role in the dot-com boom and bust. In the late 90s, Son had invested heavily in emerging tech companies as the markets continued to rise. Son briefly became the richest person in the world, and with his vast portfolio of investments, he was said to own 25% of the internet. However, when the bubble burst, Son lost over $70 billion, almost as much as Enron, and suffering the worst individual financial loss of all time. Now, as the founder and CEO of Softbank, Son controls the firm's $100 billion investment vehicle, the Vision Fund, which invests in emerging technologies, artificial intelligence, as well as the firms that can revolutionize real estate, transportation, and retail. But despite Son's rollercoaster career, Softbank's Vision Fund, the largest venture capital fund in the world, now finds itself under a pile of poor decision-making and questionable investments. Here's the fund's top 10 worst investments over the last few years, which shows how some people believe Son is one of the worst investors of all time, with Son himself saying how embarrassed he was by his own track record. Here's how it happened. In 10th place, Brandless, the cruelty-free e-commerce business selling beauty, household, baby, and pet products. In July 2018, SoftBank agreed to invest $240 million in the firm, valuing it at $500 million, and investing $100 million initially, with more money to come once the firm turned a profit. However, the retail firm struggled in the fiercely competitive market, and even a change in the corporate leadership didn't help the business. Eventually, Brandless shut down in 2020, whilst they still had just enough money to pay severance packages, cutting 90% of their employees, with the Vision Fund taking a $90 million loss. In 9th place, the mobile app Wag was dubbed the Uber for dogs, pairing up dogs to dog walkers on demand for busy workers with no time to walk their own pets. In 2017, the Vision Fund piled into the firm with an investment of $300 million. But just 2 years later, the firm sold their almost 50% stake back to Wag at a loss. Whilst the idea seemed promising on paper, the CEO, Hilary Schneider, is said to have been unable to control customer service with a data breach in 2017 and pet safety issues, with some pets reportedly being poorly treated, lost, and even killed whilst in the care of the dog walkers. In 8th place comes Zume Pizza, a pizza delivery company whose USP was using robots during the pizza making and delivery process. The pizzas were also cooked in a van whilst en route to the customer and were timed to be ready just before arrival, with a robot cutting and boxing the pizza. The firm attracted attention in 2016, with the Vision Fund investing over $375 million in 2018. However, in January 2020, just over a year after the initial investment, which valued the firm at $3 billion, Zume Pizza announced they were going to lay off 80% of their staff, pivoting away from pizza into efficient robotic packaging for other delivery companies. Pivot being the Silicon Valley word for switching to Plan B when Plan A fails. Coming in at number 7, Katerra, the technology-driven off-site construction company founded in 2015 by Michael Marks, the former interim CEO of Tesla. The firm piqued the interest of the Vision Fund as it would fabricate walls including doors and windows off-site, which produced a higher quality finish at a lower cost, and SoftBank invested $835 million in 2018. After what seemed to be a promising company, the firm was tripped up in Q3 of 2019, pulling out of at least 6 apartment and hotel projects and only delivering 1 project on time, as their co-founder, Fritz Wolf, quietly left his position, raising questions around the leadership. In December 2019, the firm announced it would be making 200 workers redundant in a bid to reduce costs and move to a more automated robotic manufacturing in their new factory in California. In 6th place, DoorDash, the food delivery service launched in San Francisco in 2013, which received over $500 million in investments from SoftBank in 2018. In a more positive light, DoorDash has been fairly successful, exceeding Grubhub and Uber Eats in US food delivery sales in 2019. but its reputation has been tarnished recently thanks to a data breach where customers, delivery drivers, and merchants had sensitive data stolen, as well as controversy on their tipping service, where customers' tips, meant for the delivery drivers, actually went to the company first, with only a small percentage going to the driver. Lawsuits were filed against the firm for misleading the public, and the firm has since changed their terms. Softbank, with a stake in DoorDash and Uber Eats, has encouraged a merger in a bid to stem the losses of both parties, with DoorDash rumoured to have lost over $450 million in 2019 alone. In fifth place, and continuing the theme of SoftBank competing against itself, is the Vision Fund's investments in South America. The Vision Fund has invested over $20 billion into Didi Chuxing, Rappi, and Uber. All three firms are delivery and transportation firms by nature, delivering either people, products, and at times even services, with Rappi offering dog walks. The issue is that these three firms are embroiled in a price war. It essentially means that SoftBank are fighting against themselves, because as one firm gains market share in Latin America, the other two lose out. You'd imagine that the end goal would be for all three firms to merge into one major player, but the chances of that happening are probably slimmer than one of Zume's robotic pizzas. In fourth place, and just missing out on the podium, Fare, the car leasing startup founded by Scott Painter in 2016. SoftBank invested almost $400 million in Fare in 2018 after being attracted to them when they acquired Uber's leasing subsidiary business. After SoftBank's investment, which valued the firm at $1 billion, they used some of the capital to acquire Ford's Canvas subscription platform, hoping to add to their 45,000-strong customer base already in the US. However, just a year later, SoftBank were putting pressure on Fare to trim their costs, leading to higher down payments on the loss-leading leasing program and eventually a 40% cut in staff. Painter, the CEO, then resigned in October 2019. And just 5 months later, Fare halted their short-term lease deals. They've since named an interim CEO from SoftBank in Painter's place. It's unknown whether these changes came from the pressure on Fare from SoftBank or the pressure surrounding SoftBank itself thanks to its poor performance. Coming in third place is OYO Rooms. Founded in 2013 by Ritesh Agarwal, OYO is a hotel franchise which finds relatively unknown budget hotels and refurbishes them to look like the OYO brand. With more than 43,000 hotels and over 1 million rooms worldwide, it's India's second most valuable startup at $10 billion. And that's following a $1.5 billion funding round with the Vision Fund, and Agarwal borrowing billions from banks personally guaranteed from Son himself. Similar to WeWork, Son was wowed by a charismatic founder, and both firms have spent heavily on new locations. This fast growth has damaged the loss-making firm, with OYO losing $335 million in 2019 on $951 million in revenue. As the retail and leisure industry has been hammered in Q1 of 2020, with lower disposable incomes and non-essential travel being avoided, OYO has already suffered a 60% decrease in revenues, which will likely dent their $10 billion valuation, and they look set for financial ruin unless someone can bail them out, with just one company in line to do so. In second place, and just missing out on the title, is Uber. Whilst being able to book a taxi at a moment's notice on your phone is great for the consumer, Uber's business model and overvaluation has left the SoftBank Vision Fund with more questions than answers. Having invested in the firm twice and buying a total of 221 million shares, the Vision Fund has invested a total of $7.6 billion into the firm. Halfway through trading on Friday the 17th of April, and the share price was around $28, valuing their investments at $6.25 billion, with a total loss standing at $1.4 billion. What's more is that increased scrutiny on foreign investment in the US has led to SoftBank also losing the 2 board seats that they were due to be given after acquiring a 16% stake in the firm. For most investment funds, a $1.5 billion loss would top the list, but the Vision Fund has gone one further. And the winner is WeWork, or should we say loser? After investing over $18 billion in WeWork and seeing its valuation drop from $47 billion down to $8 billion in a matter of months, WeWork tops our list. But how did WeWork get it so wrong? Follow their eccentric founder, Adam Neumann, and check out our video on them to find out. Some people suggest that SoftBank has become a signal that the market has peaked, and others suggest that SoftBank's strategy in a nutshell is throw money at everything and one jackpot will save you. The Vision Fund has taken a serious beating over the last few years, with 2019 losses approaching $17 billion, and even some of Son's personal investments have raised eyebrows. In 2017, Son invested in Bitcoin when it neared its peak of $20,000 and cashed out for an estimated $130 million loss. With fundraising for Vision Fund 2 in the works, it remains to be seen if investors will actually return after such a negative few years. And that's how it happened. Let us know what you want to see next by leaving a comment below, and we'll show you how it happened. Thanks for watching.